Hey, good afternoon, everyone. Chris Lopez here. I'm the blue shirt. Terrance Doyle is over in the white shirt, and we're the host of the the Real Estate Ride Along Show. We happen to live in Denver, but we just walk properties mostly around Denver, multifamilies, a couple other rental properties, and we are starting to do some YouTube live Q&A to answer not only multifamily investing questions, but just other questions in general about investing whatsoever. So if you got, deals you're working on, questions to do, Terrance is a very active investor, been investing for about a decade now. I'm an investor, I'm a broker, and so we both do a lot of deals. We see a lot of stuff out here, and we're happy to answer your questions. So Terrance, glad to have you on the show.
Chris, yeah, excited to be here. Round number 2 of Q&A on YouTube, and excited to see what questions we have and how we can help everybody out there that's looking to expand their real estate portfolio.
Yeah, so if you guys have questions up in here, drop them to YouTube. And
someone set up in here on the
yeah, that's what I get for talking and reading at the same time, huh? So drop your questions in here, we'll answer them. I think we should actually probably create a little fancy banner here too. Look at that. Look how fancy that is.
So Chris, what are you seeing in the Denver market right now? We were just talking about 11-unit condo portfolio that came out that you were passing on for your clients. What else are you seeing out there?
Well, in Denver, I mean, we're seeing cap rates continue to be compressed.
Really? Going down?
Going down.
Okay.
I mean, I think it's the biggest reason is because, we've been in a good bull market for almost 10 years now. Denver, as you know, is one of the first markets into the crash a while ago, and now it was the first ones to recover.
Right.
And Denver's just been a growing city with populations, job growth coming here. And it was always been a hot market, but when interest rates dropped again because of COVID, just seeing a lot more demand. It seems like properties are getting a lower and lower cap rate.
What are your clients getting interest rates at right now for multis? So
interest rates?
Yeah.
For like 5+?
5+,
yeah. Depending on the term of there, we're seeing from like 3.5 to low 4s for this is for like the portfolio
5-year
stuff.
fix, 7-year fix?
5-year around like 3.5, 3.6, 7-year in the high 3s, and 10 in the low 4s is what we're seeing. Because we just closed on one property up in Aurora next to that fourplex you had.
11 unit? You closed on that today?
Yeah, just closed like 2 hours ago.
Nice, dude. Congrats.
And he got a 10-year fixed at like 4.0 something.
Local bank or national?
Local bank.
Local.
Yeah.
Nice.
So let's start answering some questions here.
What do we got? What's the snowball investor talking about? That's interesting.
Where is that at?
Up there.
All right. So the snowball investor says real estate investor with 10 condos. Ooh. So let's talk about this. If you got other comments on their snowball investor, put them in here. But this is a conversation I have with my clients a lot. It's just like, should I invest in condos because of HOAs? You got an opinion on that, Terrance? I've got a big opinion, so I'm going to ask you first.
I don't know the gentleman's name, but the CEO of Renters Warehouse says that if you have children, the best way to create their college fund is to buy a condo and just rent it out till they're 18 and then sell it, and that'll pay for their college. So what I gather from that is that he believes that it is better than putting a college fund in the stock market. I don't own any condos, so I couldn't really speak to that personally. I don't know. I buy houses and I buy apartments. I have bought a condo and flipped it, actually, several near DU here at Denver University. But as far as a buy and hold, yeah, the HOA, I don't know. The cash flow just never made sense holding it with an HOA. So
the interesting thing is for a lot of just, we're just talking general like turnkey stuff,
right?
Not, major value add stuff, but the best cash flowing turnkey stuff are condos in Denver right now.
Oh, yeah.
Even with the HOAs, because we got the higher HOA, but then your taxes are lower, your insurance is lower, your repairs and maintenance are lower. And a lot of other fees are lower,
right?
But just do like the price point to ratio or, rent to ratio price points are so much better. Like, for example,
so for the HOA, what do you get in cap rate?
So I bought a 3-bedroom, 2-bathroom condo in Aurora 3 months ago, with conservative underwriting. I'm at a 6.3 cap rate. And so it's basically a $200,000 3-bedroom. Can you find a 3-bedroom house for $200,000?
No.
I mean, at best case, you'll be at a $300,000 price point,
right?
Most typically. So that $100,000 difference, and that's an extra, what would that be? An extra, let's do math here real fast. $100,000. Let's see, how would be 25 times? I mean, that's gonna be an extra, I can't do the math right now, but extra few $100 a month in mortgage payments.
Mhm.
And just the fact that we can buy condos so much lower, the HOA is still a better
Deal than
cap
that.
rate. Because you out there buy a 3-bedroom house, you're gonna be at like a 5.3 cap rate.
I guess the question is, depending on your stage in life and what you're looking for, if you're younger, so I would say if you're under 40, you get more appreciation in Denver if you just buy a house and pay a little bit more and get a little bit lower cap rate. So let's say you're in the high 5s versus the 6s, you're going to get that back in appreciation, I would say. So I guess that's been my take, is why I would lean towards a house, is just because I'm going to get a bigger pop on the back end if I ever need to sell it or for a HELOC. But I agree with you on the turnkey passive side.
Yeah.
If you're looking for stability and consistency, then I could see the condo making sense. This is my personal opinion. I don't think you can go wrong in Denver as long as your price point's right and you understand the rents.
Well, so condos are appreciated about the same price as single family properties out here too in Denver. But the second thing is, like, I think condos may see a bigger pop in appreciation, because if you can still buy a $200,000 3-bedroom condo, I think those will get bid up because it's just so more affordable.
Condos are appreciating the same rate as homes in Denver
Historically. Last
Really?
I think houses appreciate like 6.1%. Condos are like 5.7%. So a very small difference,
discrepancy. Yeah.
like 0.4 of a point. So if you guys invest in condos out there, let us know if you love them, hate them, because most people
Let us
either
know
love
where
them
we're
or
off
hate them.
there. What's Yankee Doodle talking about?
I'm gonna pick this one
Oh.
instead. We got to help out an Army veteran here.
Okay.
So he says, or she says, I'm not sure who that is. I've spoken to several people about future income applying to your income property / IES. Oh, properties.
Yeah.
How can a potential renters be applied to your loan pre-approval? I'm a U.S. Army veteran. So this, as far as I know, this applies for, whether you're using a VA loan, FHA loan, or conventional loan. But if you're buying like a duplex, triplex, or fourplex, you're buying one of those properties. If you're living in unit 1 and unit 2 has income coming in, that can be applied towards your debt to income ratio. So if you're, let's say, for example, you qualify for a $300,000 loan as a single family home, but then a duplex is $400,000, but has $1,000 a month in rent from unit 2.
Right.
Well, that unit 2 can be counted towards your income to help lower
the DSR.
Your debt to income ratio, or raise your purchasing price, whatever you want to talk about it. And so that's definitely a question you want to talk to your lender about. But we've done quite a few deals like that where great people have gone over what they've been pre-approved for in a single family residence. And then they've bought a duplex or a triplex, use other income. It's actually they've been able to qualify for their property. So I believe the underwriting rules are they can use, I'm not sure in that case, it might be either the full rent amount or 75% of the rent amount that you can use to count towards that.
It probably varies based on the local market, I'm guessing, based on how those local banks are underwriting those properties in that area.
Well, for this is all like the government, Fannie, Freddie, Ginnie stuff. So that should all be consistent across the nation. So yeah, I mean, the best thing to do there is, if you talk to several people, you need to talk to a lender, because a lender is the one that, talk to a lender and find a lender that knows investments and hopefully knows, I'm assuming, house hacking or whether investments, one or the other. Talk with a lender, give them all your documents, let them pull your credit, give you the full picture, and say, hey, what can I afford to buy as a single family rental? Now, if I go out there and buy duplex, how does that extra income affect my buying power? But you got to talk to a lender for this, because, you're talking to other people, probably like me and Terrance. Oh, yeah, you can do it. But the lender holds the purse string, so you got to talk to a lender. All right, who do you want to?
Well said. Let's go to Kara right there.
Okay.
College senior.
So Kara says, I'm a 21-year-old college senior with some money, but no steady income. It's from internships and scholarships. One idea is to partner with a mentor, but how do I convince someone to do that? So great question.
I love that.
Great opportunity.
Ding, ding, ding. Great question. I have been particularly interested in this topic with how colleges are changing the way they're going to teach. So higher education, sidebar, I think it's ripe for disruption. Back to real estate. I think that if I was 21 years old, a college senior with a couple bucks in the bank and no steady income. How do I get a mentor? The number one, so for me, it's people have to like you and trust you. So if you meet with someone that's older, has some experience, and is advanced in their real estate career, and you come to them and they like you and trust you, they're going to want to spend time with you and help you. Naturally, just the way human beings are, they want to help other people, especially if they think that people are serious about learning and growing and being coachable. So if you have, and what I would say, just being tactical about it, if you had a list of questions, you knew the person, right? So even if you don't know them personally, but you looked them up on LinkedIn, saw what they've done in the past, where they went to school, maybe the neighborhood they live in, or other things that they've accomplished, and you came with a list of questions that were relevant based on their career, saw that you had done some research, done your homework, and had some relevant questions. I think the number one way I get interested in helping people is if they ask me relevant questions. So if someone comes in and says, "Hey, so where do you invest in real estate?" And everyone knows I invest in Denver and Des Moines. It's like, this person hasn't even spent 5 minutes researching, my business or what I do or my, anything.
Can I interject here?
Yeah.
Because I agree with you. I'm
Yeah.
like, I agree. Spend 10 minutes on Google or
Right.
LinkedIn or whatever and do that. Because I'm like, hey, people ask good questions. Like, hey, I know you did this. Can I ask you details on there? But they ask these like very basic, I'll say questions like, you didn't even like read any one blog post or 1,000 podcasts I've
Right.
released. Like, it irritates me. So really point I wanted to underline there.
I think just
agree.
the fundamentals, like if you just do a little bit of research and have 5 really relevant questions of that person and have any point of synergy with them, like, oh, I noticed that your family's from the Northeast, my family's from the Northeast, or I noticed you traveled to this, or I noticed you did this business or this industry. Any points of, commonality, I think add a lot and just show that you're intentional, you did your research, you care, you put some thought into it. If you just show up looking for a handout, people aren't, gonna, do that much. But if you show up and you're intentional, you did some homework, you did some research, I think people are inclined to want to help you, especially if you're in college and you have a good story. That would be my first thing is research, the people that you want to work with or be like, find some interesting facts about them, create some questions based on that, and then pay for the meal, pay for the coffee, whatever. I think that goes a long way. That'd be my two action points. Do some research and pay for the meal or the coffee.
And I'll add it on there as well. I mean, because I've gone through a few cycles myself because I've had good success with finding mentors over the years to help leverage my own success and get started in a new career field, such as a real estate agent. Going there with a very, with your questions written down, prepared, and like write them down is my recommendation. And also when I was meeting around people years ago, I wrote down on less than the one sheet of paper what my goals were, my timeline was, what my strengths were in a bullet point. And that way people say, oh, what do you want to do? I'm like, cool, here's exactly what I want to do. And I would show it to them. I would leave it with them. And that way they could reference it.
Right.
And me writing it down beforehand, maybe be very clear and articulate.
Yeah.
Versus going and be like, oh yeah, well, I definitely will do that.
Right.
So I'd recommend writing things down, be prepared, and just be eager and be completely frank.
Yeah.
But if you're very eager and you're also very frank, like don't blow smoke up someone's someone's face, you'll go a long way. So
it reminds me of a conversation I had in 2017 with a gentleman named Chris Lopez. He knew a lot about marketing. I didn't know anything about marketing. And I think I showed up and just said, hey, same thing. I had a couple questions and then we took action. And
now we've done millions of dollars of deals together. Now we have a YouTube BiggerPockets show.
Now we're on YouTube Live. Yeah.
Isn't that crazy?
It's wild.
And we actually connected on BiggerPockets.
Connected on BiggerPockets. That's right.
I
had 5 good questions.
But you know what? I remember that for the meeting. You actually took notes. And you're the only person I can remember that I actually met with because he wanted to talk about like marketing and podcast stuff. And you're the only person that actually took notes. The next day you follow up with an email clarifying stuff and he actually took action. I was like, dude, this guy is legit. I like him.
The fundamentals. Yeah. I just took notes and sent you an email.
Mind blowing,
huh? It stuck out in your mind.
All right. So Wagner says, my wife and I currently have a duplex that we are house hacking, and we are currently looking for another one to invest. In this market, and which market are you in, Wagner? Let us know. It's very hard to find anything with the 1% rule. So I have very strong feelings about the 1% rule.
Sounds like this is a hot topic for you. Why don't you?
Well, I get this question like 5 times a week.
Yeah, why don't you take it?
I think the 1% rule is a very simplistic rule that oversimplifies investing. And it's been a rule of thumb that I've seen on BiggerPockets when I got in there like 5 years ago, and it's still there. But the market cycle has changed. Everything's appreciated, or any decent market has appreciated since 5 years ago, and it depends on your market. We're both here in Denver. Unless you go out there and find a really great value add place that you can, burr or do something to significantly increase the rents, you generally can't find 1% rule properties. And then you have to really understand how to underwrite the properties. Because if you get solely focused on 1% rules, you will not find properties here in Denver. I think a lot of markets around the country you won't. And I've talked to a lot of other investors, sophisticated, experienced investors when I got started, a handful of years ago. And they all just laughed in my face, the 1% rule. They're like, that's stupid. Here's how you really get rich. Don't worry about it.
I think that's well said.
Yeah.
Obviously, you've had that conversation a lot. Wagner, I would just say that I've never once looked at a 1% rule in underwriting. I think the most important thing, it's you and your wife. I don't know if you have kids or not. I would look at what are your financial goals? How much money do you have? And you really have to decide, do I want to invest in the stock market? Do I want to put money into real estate? Do I want to leave money sitting in my savings account? And if you decide, hey, I really believe in real estate long term, then whether it's 1, 2, or 3 or half of 1%, it's really irrelevant. You just have to be disciplined and buy in an area that you believe in, buy a property that you believe you can manage, and that's really it. And whether it returns a 5% yield or a 6 or a 7, if you believe in it long term and you hold it and it cash flows and you're getting debt really cheap, you're going to do really well. It just comes down to, would you rather put your money in Apple or Amazon and watch the ticker every day? Or would you rather buy a property in a neighborhood you're familiar with, maybe do some work, do some paint, come in there, change some cabinets, and maybe make a little bit less than you would in Apple short term, but long term, you've created a really valuable asset that's going to spit out cash flow. So I just think the 1% rule is one of those things that sounds good, but what does it really mean? You really have to understand your goals, get back to, what is your cash position? What are you looking to do short term, long term, and then decide on a game plan. And if you decide that the best thing to do with your cash is real estate, then you just have to stick to the principles and be disciplined in saying, hey, I want to buy in this area, this price point, this kind of, cash flow.
Yeah.
And that's really the thing versus the 1% rule that doesn't really apply, as there's a shortage of housing and there's a lot of demand for housing. So you're not going to be able to get what you could do. I mean, I feel like this was like 10, 15 years ago. People were talking about 1% rules.
Yeah.
Which really only applies in the Midwest now, where you have a lot higher taxes and your cap rate gets to almost about the same once you include, all the utilities and taxes and other expenses you're going to have out of state.
And that's a good point, because it doesn't take into account any of the other expenses. You have to learn how to
You're
underwrite
totally
it.
looking at gross revenue, which is irrelevant when you're looking at what is your net profit, which is why I think if it's your first investment, you got to look at your goals, your cash position, and I would be doing something in my backyard that I can go touch it, feel it, see it every day.
And the other thing I'll add on there, Wagner, is, really learn how to underwrite properties, as Terrance started alluding to, and make sure you understand the 4 ways to make money in real estate. I think on my podcast I run, the most popular podcast I have to date is titled Cash Flow is Not Everything. That's something else on there, but talks about the 4 ways to make money in real estate, which is cash flow is 1, then appreciation, then debt pay down through your tenants, and also tax benefits. Look at all 4 of those returns as well to understand the underwriting, and you'll quickly realize, hey, the 1% rule, not that big of a deal. So here's a good question from Rob, and this is definitely up your alley, Terrance. Rob says, if I wanted to pool a group of friends' money together for private funding on a larger multifamily property, what would your recommendation be on how to structure the deal? Because you do a lot of deal structuring now, Terrance. So this is definitely up your alley.
If it is a group of friends, obviously this is a little bit of a loaded question, because I don't know the age. I don't know what their financial situation is, how much capital they have, what their income is. But I would say when I started out investing 6, 8, 10 years ago, I was doing very simple structures where I would go to a friend like Chris and say, hey, Chris, I'm buying this house. I need 50 grand or 100 grand. I'll guarantee you 12%. And I would say, if it was a shorter deal, 6 months, if it was a longer deal, 12 to 18 months, and I would just give them a preferred return. So they knew what they were making, and I had to perform in order to make money. because I had to cover the principal plus the debt. I think the debt, if you're starting out and it's friends, I would prefer to do debt. And I would do something like, 6% current, maybe you pay monthly, and then 6 to 8% when it sells. And then you can put in something like if it sells over a certain number, you can add on 2 or 3 or 4%. That way they get a kicker and a little extra sugar if it performs really well. But I just think, you don't want to get into having to structure something legally where you have like an operating agreement, a JV agreement, and you have different class members, a class C and class B members. That gets expensive, it gets cumbersome. And if you have 4 or 5 friends and they're really just looking for a double-digit return or an above market return, which is, I would say 1% in your checking account right now, or CD or money market. I don't even know if it's that high. I would say, do something that's just a fixed rate of return, preferred return, over a fixed period of time. So 6 months, 12 months, 18 months. I think if you're offering people anything north of 10%, 12%, I think they're going to be ecstatic. Obviously that depends on your experience. That's how I would structure it.
And so you're saying, I'm going to repeat this back because
Yeah.
I want to, like I said, this is an area I don't know much about. So you're saying have, say Rob, for example, he's the main guy, but then he's taking the property and loan in his name, but then he's pulling his other friends' monies together and saying, hey guys, regardless of how good or how bad the property does, I'm going to guarantee you 6%. Just, hey, if you give me $100,000, I'll pay you 6% a year.
Yes.
And then if it performs greater, add some bonuses on top of there.
What I've seen is 6% current. So I'll pay you 6%. So if you give me 100,000, I'll give you 6,000 a year. You can either pay that monthly, semi-annual, or just one payment annually. Depends on their situation. If people are looking for monthly cash flow, then you have to, toggle it back and forth. What I've had good success doing is I'll either let's just agree on 10%. I'll pay you 10% annually for the money, whether I sell it or not, or refinance or not, 10%. Or if you want to add another layer of complexity and a little bit higher upside, you could say 6% current, paid annually. So you owe them 6,000 a year on 100,000. And then when I sell it or refinance it, I'll pay you another 6%. So they get 12. So the 6 is current, and the other 6 that make up the 12 was paid either upon refinance or sale on some kind of liquidity event. You could do very simple, and you could just say 10% for the money paid annually. And that's a lot simpler. Obviously, in today's world where people are seeing a lot of opportunity, if they have a lot of cash, 10% may not cut it. You may need to do something current and then do something upon sale or refinance. I would say I would go with one of those 2 options, Rob.
Great.
To keep it simple.
So Stephanie has a question here. Stephanie says, I'm a real estate agent. I want to purchase a multifamily in Miami, Florida, but I do not want to put down the 20%. Is there any way the lender can allow me to purchase multifamily with FHA for the minimal down?
You probably see this a lot.
Yeah.
You should take this.
You can just live in the property. I mean, and that's the reality. If you want a very low or a very high leverage, low down payment loan for multifamily, live in it.
What are the programs they're offering right now? The government's offering.
The 2 that I know at least work in Denver are FHA, and that's usually 3.5%. Or if you're a veteran, go get a V loan and do 0% down.
So if I'm not a veteran and I find a fourplex, let's call it, just for easy numbers, $1 million. I can buy that for $35,000 down, 3.5% down. And if I live in one of the units?
Yes, with some rules on there. They have some other underwriting rules where they have to have I think they call it the self-sufficiency test. I might be butchering that.
Has to have some kind of debt to income ratio.
Yeah, because I had a client, he bought a fourplex with FHA, but to meet the self-sufficiency test, I guess you have to do rents to purchase price. He ended up putting down 7%, which is still incredibly low for a fourplex. Right. And depends on the price point. Miami.
Does the interest rate go up? So if a typical interest rate right now we agree is 3.5%, does the interest rate go up then the more leverage you're taking?
No, because it's owner occupied, so you get the better rates.
Okay.
I mean, right now,
that's killer.
We're seeing stuff around 3% for FHA stuff.
For fourplex?
Yeah.
Oh wow.
And I'm doing a refinance on an investment fourplex at 3.5% right now.
Wow.
The one I bought from you last year. Yeah.
Really?
Yeah. 3.5%.
For how long?
30 years.
No way.
Yeah, it's a Freddie Fannie loan. Yeah, or one of those. So yeah, I mean, Stephanie, if you're owner occupant, you can buy stuff FHA. If you're not owner occupant, then what we've seen from the long-term financing, you're at 20% down for conventional. There are some programs for low income qualified people tracks. It's definitely very city by city. Like in Denver, we don't qualify for it out here. And I have seen some local credit unions that will do a lower down payment on investment properties. So you may want to talk to like your local banks, not your Bank of America's, but like the local banks that are only in Florida, because they can give you some different products. But if you're going for 30-year fixed stuff, FHA is a way to go for low down payment stuff. Ooh, all right. Let's see. I'm scanning for some multifamily questions here. I saw one.
Dave Carter.
Yes, thank you. So Dave Carter says, a question on should I buy a multifamily between 4 to 8 units versus 3 to 6 single family homes? If you can only do one or the other, what would you do? What are your thoughts?
Dave, interesting question. I've spent many nights noodling on this same question. I think it comes down to your tolerance for risk and how much cash you have. If you have extra cash and you live in an area where the residential market's appreciating like Denver, 6 to 8% year over year, you should definitely look at single family for the main reason that rents are not going to appreciate as much as single family homes in Denver neighborhoods are appreciating. They're just not. And I think actually rents in Denver could be leveling off the next couple of years, and single family homes have shown to still be appreciating. However, if you're looking to protect your downside, I would strongly look at multifamily for the simple reason that if someone moves out of your single family home and it takes you 3 or 4 weeks to repaint it, carpet, do any kind of turn to it, you have to pay the mortgage for that month. There's no other tenant, right? The property's vacant. You're paying that mortgage. In multifamily, even on a fourplex, I believe, and most of the properties that I've done, if I have 2 tenants in there, I'm covering the mortgage. Now, I may not be covering the taxes, property management, and other utilities, but at least I'm covering the majority of that mortgage payment. So you just have less risk on multifamily. You have the compounding effect of the cash flow, and as rents increase, you're selling it based on a compounding effect of the rents. Single family, you're going to sell based on what the neighbor and what the neighborhood's worth. But if you're in Austin, Nashville, Denver, where neighborhoods are appreciating 6 to 8%, you can get great appreciation. You're going to have a little bit more risk. If a tenant moves out, you're going to have to pay that mortgage. So it just depends on your cash position, what market you're in, and how much risk you want to take on. I think right now you could have a little bit more upside short term with single family, a little bit higher upside, a little bit more risk. Multifamily, lower risk, and you could say lower upside in the short term because of rents are not going to appreciate and grow as much as the appreciation on single family homes. Although long term, I believe in that rents will stabilize. It's going to continue to grow at 2 or 3% a year over a 10 or 20-year period. I think if you're looking shorter term, single family probably has a little bit higher upside.
Yeah, and I think a lot of it just depends on what's going in your market. Like,
Right.
what I do a lot with my clients who want to get investing. Hey, I want to buy this type of property. I'm like, great, let's talk about this. But hey, we're also seeing these type of better returns in this asset class.
Right.
I'm like, hey, let's go look at both types. Let's go look at single family homes, look at condos, and let's look at multifamilies.
Right.
And compare all three, run numbers, walk them. And once you run numbers, you walk them, that will give you a big education as well.
Yeah.
So actually, I saw a question earlier from Dave as added on here. You started alluding to this, Terrance, but Dave asked another question. I'm looking at doing a few single family BRRRR deals, the buy, rehab, rent, refinance, repeat deals versus a 4 to 8 plex. What are the pros and cons? With our funds, we could do 4 single families or 1 multi, but not both. And if you're talking to do I'm reading it this way, so I'll answer it. Is either, burring a few single family homes or burring a multi-unit. If you're able to do both, what Terrance said earlier was I would lean more towards multis because, while you're turning, let's say you buy a 5-plex, while you're turning 1 unit, great, you got 4 of the rents coming in, you turn 1 or 2 at a time.
That's right.
Plus, I think economies of scale, because I've walked your properties, Terrance, and your properties, they're an assembly line, especially your multi-units.
Right.
Great. You're doing 5 units at one property. It's the same materials for all of them. You're doing 5 single family homes. It's probably some same materials, but some different materials, and then you're driving around. So I think for economies of scale and just effective income coming in, I would lean towards a multi-unit.
Yeah. Sometimes it's harder to get the BRRRR on multifamily because banks are pretty conservative regarding what you bought it at, what you put in it, and what they're going to give you back. I've had better success buying single family homes. Again, not in Denver where the homes are $500,000 or 400,000, but I've had a lot of success in Des Moines buying homes for 40, 50, $60,000, putting in 10 to 20,000, the home appraised for 120, and I'm able to pull out the majority of the cash that I had in. So I'm in at net zero, as far as cash, but then it's cash flowing. So I've had good success in that in tertiary markets where the single family home price is a lot lower. I think if you're looking in Denver, I like buying I like buying a multifamily, adding some value, and then you can refinance it. But again, you got to be patient. We get back to this. You're not going to be able to pull out all your cash in the first year or 2 years. You might take 4 or 5 years, but over time, you're going to be able to refinance 1 or 2 times over the course of 5 years, pull out the majority, if not all your cash, and the rents have gone up. You've had some depreciation every year, so you'll be able to write down the income. And I think you're net, a lot farther ahead. I think one of the things to look at is the neighborhoods and the market. Like I said, in Des Moines, where it's not going to appreciate as much, I've been able to pull it out, pull out the cash, but then it's not appreciating, so you just got to, I think you got to weigh all those variables. But if I had to say what I do in Denver, I would definitely buy a fourplex and try and burr that before a single family home.
And there's a big difference too, Dave. I mean, if you're talking about burring a fourplex versus burring a fiveplex, those are two very different worlds because of lending.
Right.
Fourplex is residential, fiveplex is commercial. So, really know the nuances between the two. And we've had good luck out here. Now we don't do the extreme value stuff that you do, Terrance, but for a lot of our clients, we're seeing some really good, I'll say, like medium term value add plays for like the 5 to 20 unit multi range,
right?
Where it's like, hey, someone's owned this property for 20 or 30 years. It's under rented, it's under managed, or, and just all, and it's a good property, good location. And just say, hey, come in there, do better management. Start trimming some units with some cosmetic updates. Do some CapEx expenditures, a new boiler or whatever needs to be done, and then turn a couple units. And then, over the next 8 to 12 months, you can have them fully up to market rent. Then usually they need like, 6 months worth of stabilization or seasoning. Then go to a bank and refinance it. And we're seeing some really good deals here, better than single family stuff and better than like duplexes and fourplexes.
Well, if you just run the numbers, the average home price in Denver is like $450. So 4 of those, you're at like 1.8 million. You can buy a fourplex all day for between 6 and 800,000.
Yeah.
So you're going to get, I think, your lower price point. Like you said, you can go FHA. So, if I'm burring, I'm definitely trying to do a fourplex in Denver. If I'm in Des Moines, I think you might, it's a lot tighter because you can pull out a lot more cash because your entry price for single family is a lot lower.
All right. So a follow-up question here from Wagner. Do you think that we will see more houses coming in the market when the lift or when with the ends of forbearance and evictions? Again, very local specific, but in Denver, no, I don't think so. Not the data I'm seeing. I mean, there'll probably be a small uptick, but there were months in Denver, like this was pre-COVID stuff, like in like November for sure. I think like February as well. There was one foreclosure in the entire like Denver metro area. And, we've got, I don't know, 3.5 million people here. And there's like one foreclosure. So at least in Colorado and Denver, we have such high equity and have had such great appreciation the last couple of years. There's very few homeowners getting into like, bad situations. And from looking at high level data from other markets, again, I dig into stuff on, Denver. I read headlines for national stuff. Overall, most of the nation seems to be like a housing shortage. So if we have high demand and low supply, that keeps prices going up and usually means that sellers have the ability to sell quickly and usually not be underwater in their properties. So I'm telling all my clients here in Denver, like, yeah, don't hold your breath on that because I don't think it's going to happen.
Yeah, definitely not Denver because of supply demand. Like you said, there's so much migration, very little supply. Don't expect a lot of foreclosures in Denver. I would say Austin, Nashville, Dallas, places where you see a lot of migration, people moving in and not a lot of supply, then there's not going to be a lot of foreclosures because there's people can just sell and they have a lot of appreciation. I think, again, you're looking at the Southeast and maybe the Midwest for foreclosures.
Let's see. There's a question I saw up here. Here we go. So Angel asked, should I buy land to build my own multifamily unit to my own eco-friendly specs and make income that way? I'm assuming comparing that to just buying an existing multifamily? I mean, you've done some of both. I mean,
So, Angel, if you're going to buy land and build multifamily, I hope you need to have a lot of cash or a lot of investors. When you buy land and you take a loan against it, you're going to have a payment every month and you have zero income coming in. So you just have to run the numbers. It's very, very expensive. In a city like Denver, where there's a lot of growth, getting a permit to build is on something multifamily. And if you're talking eco-friendly, you're probably talking about 12 to 24 months to get the permit. So that means you're carrying the note for 24 months and then you're building for another 12. So you're talking about 36 months of carrying costs. You're talking taxes, insurance, and the mortgage for 36 months. So yeah, is building a good idea? Yeah, it can be an amazing idea. It can be a great way to build your own income and do it the way you want, like you said. But you just have to have a lot of cash reserves to cover the carrying cost. That's one of the reasons why I've done a couple new builds. And by the time I get done with it, I'm like, I literally Columbine, I don't know, I mean, 24 months building this thing. And in the course of that, I've probably bought and sold 200 units that I renovated and created income all along the way from day one. So it's just, if you're starting out, I think that there's other ways to create income that are faster and less risk. There's a ton of risk as well when you're buying land and trying to develop. I think one of the things is lending. They're only going to, a bank is only going to lend 50% of the purchase price for land. So you need to come up with 50% of the equity to buy it. And then you're talking about all the carrying cost while you're doing the entitlements, going through things with the city. So, if you're an experienced, savvy investor and you have a lot of profit that you've collected over the years and you have some extra chips, then yeah, I would look, I think looking at that is, could make some sense. If you're starting out, I think there's a number of better ways to create some income.
and it also depends on just what the numbers are like in the market. Like as Terrance alluded to, here in Denver, the numbers don't make sense to go out there, buy land, and build a multifamily for rental purposes. Now, if you're getting some low income housing, federal tax credits, or things that offset true market conditions, maybe.
Right.
But from a pure just, you go out there and buy land, numbers don't make sense in Denver. What developers are doing is they buy land and they build a very high end condo or a high end row homes. They sell them off individually to develop and sell.
Right.
But to develop and rent, the numbers really are hard to make work here in Denver
because the land's so expensive.
Yeah,
that's right.
And it's I think building costs are so expensive too, right? They've gone up a lot in Denver.
A lot.
Yeah. So it depends on your market conditions, but I mean, what we're seeing here in Denver basically doesn't make sense. And I mean, especially you build the eco-friendly, like, I get that, but that's not going to probably be like anywhere near the
most
best
economical
numbers.
way to build. Yeah.
I like this question
Oh.
from Brian. If you guys were 21 again, wouldn't that be great? If you're 21 again with 3 single-family rentals owned outright, about $500,000 and $100,000 in income, what would you do in this market? I want you to branch out into multifamily, but don't know where to start. So, dude, if you're 21, you've acquired those assets.
Then congrats. Pat on the back if that's you.
I was,
first of all,
at happy hour not doing that when I was 21. So good job on you, man. Ooh, that's such a good question. So if your whole long-term goal here is just, to build long-term wealth, something you're a younger guy, so you got a higher risk tolerance, a very long time horizon. If you plug these numbers into spreadsheets, they will tell you pretty much all day long to either sell or to cash out refi, depending on how the numbers play out, re-leverage up and go buy more properties. Now that's for rentals. If you're looking to buy more rentals, the basic rule of thumb here is leverage is going to get you greater returns. Hey, if you sell those and you have like say $400,000 in down payment, well, you can go out there and buy a $2 million apartment building or so, maybe a little bit less than that, and then go buy a better performing rental property. Or you could sell or pull out some cash if you want to do some more like fix and flips and borrow. Like, hey, great, so take some of the equity and go start a real estate business with it, like Terrance does. Hey, he's going out there and finding great value add deals. Go out there and do that. So it kind of depends what your investing goals are. But what I would do is I would tap in the equity one way or the other based on what your goals are. Secondly, I would keep really high cash reserves because you're young. The name of the game right now is to make sure you just don't lose anything. And I was young.
Stay in the game.
Yeah, I definitely made good money, but I also was very stupid with my money in my younger days. So keep high cash reserves to avoid things. And then just do like 1 or 2 moves at a time. You're really, really young. You don't know, no deal now is going to make you for retirement, but one deal could break you and make you start over in a couple of years. So be conservative. Like, hey, take one property, do one thing, learn from that, and then move on from there. It's a long, long chess game.
It's a long horse race. Yeah, I think if I were you, and this is your metaphor for describing your situation, if I'm in a market that has a lot of migration and high occupancy, I'm definitely leveraging up, either cash out or HELOC, because you get the cash out and they're rented, you have a good property manager, or you're just managing them and you know you can keep them full, then there's very little risk in putting the cash in the bank, building relationships with multifamily brokers and waiting for a deal that you feel comfortable with. But I think that's the best way to grow. If you look at any of the guys that have crushed it in real estate, they started out with something small and then they grew to multifamily or office space or retail or industrial. But I think most people would say they started with residential and then they grew, and then they scaled up. So I think the one thing you want is optionality. And I think the way to do that is to refinance, take some cash out, and then do your due diligence on your market and look at, multifamily. You can look at industrial is really high. You could look at mixed use or mobile home parks. I mean, there's just so many ways to scale up if you're in that position. But the nice thing is you have optionality, you have income from your full-time day job, and you just create a lot of options with that situation.
So we got time for a couple more questions. So we'll try to get through as many as quickly as possible. Matthew asks or says, any advice to a new investor on how to invest in multifamily out of state and how to get started? I'm an upcoming college graduate with not much capital, but want to get in the real estate business. I live in Pittsburgh.
Shout out to Pittsburgh. I've spent a lot of time in Pittsburgh. My in-laws are from there.
Oh, yeah.
Great city. Matthew, why do you want to go out of state? Pittsburgh, there's a ton of opportunity. There's a lot of old buildings, a lot of value add to be had in Pittsburgh. There's a lot of neighborhoods you can go in there and buy properties, pennies on the dollar, put in some sweat equity and renovate and rent. I think, we have a podcast on out-of-state investing. You could go back and listen to that. I think the number one thing is you have to ask yourself, why are you going out of state? What is the purpose of going out of state? If you're new and you're looking to build relationships and get into real estate, I would find an operator in Pittsburgh and learn from him. Find a way to add value to him, like we just talked about earlier. Find a way to understand his background. Find things in his business that maybe he's not doing or not doing well that you could add value. Maybe he doesn't have a website, or maybe he hasn't. Maybe he needs someone help on construction. Find something that he could use some help with. Do that, even if it means doing it for free. Learn the business. Get your hands dirty. And I would focus on Pittsburgh. I think there's just a ton of risk of going out of state. And if you're in a market like Pittsburgh, there's so much opportunity there. Find an operator, find someone to partner with. You obviously have time and energy and sweat equity you can give to someone else that has experience and capital. So I would find someone that your sweat equity matches the capital that someone else has, and maybe they don't have the time you have. And I personally know there's a ton of deals, ton of opportunity in Pittsburgh, multifamily or single family. There's no need to go out of state.
Plus, if you don't have a lot of capital, it's going to be very hard to invest out of state successfully.
Right.
Because for most out of state investors I talk to, they buy it and then they usually need to bring in more cash. Like, oh, yeah, we thought this. And then they get a black eye. So, I mean, I agree with everything Terrance said. The one thing I'll add on there is if you're living in Pittsburgh, house hack. If you're low income, cool, go get an FHA loan for 3.5% down, or maybe another program for a lower down payment. Buy a property, house hack it. If you can renovate it, great. But invest in your backyard. All right. So we have time for one more question. So Roman says, I'm a veteran exiting the military in 2 months. I have over $40,000 in savings and haven't used my VA loan. Would it be a good idea to buy a multiplex with a VA loan and another one with the savings? Yes.
First of all, thanks for your service. Big fan of military. I would start with one at a time. I think if you're leaving the military, you want to get into real estate, do one project. You're going to have a bunch of failures. There's going to be a bunch of areas you can improve on. You're going to learn a lot of lessons. So just do one at a time, and definitely use your VA loan. If you can do a duplex, triplex, fourplex, I would do that. just because it lowers your risk and increases the upside. But do one at a time. Learn it with the VA loan, wait a year, and then evaluate where you're at, what you enjoyed about it, what you learned, and then figure out where you want to go from there. But I definitely think, yes, get as many units as you can with the VA loan, and you're going to learn a ton of lessons, and it's going to be a great experience. And then in a year, reevaluate.
I agree. I would start off with one thing at a time. And I would make that a house hack with your VA loan, especially now we got COVID going on. Market's been pretty well so far, but hey, we still have probably another year or so of wearing masks and the COVID stuff, unfortunately. So you need a place to live, buy a house hack to live in, keep cash in the bank, because in times like these, cash in the bank is, I think, one of the best things to be in position of. I'd rather pass on a deal, keep more cash in the bank than get a deal and get stretched too thin right now.
That's right.
So yeah, we would both recommend go out there, buy a place with a VA loan. Awesome, guys. Well, thank you everyone for listening. Terrance and I really enjoyed doing this. So we are going to wrap up now, but make sure you click subscribe to BiggerPockets, click the bell notification, get notified. And we have a small break between some ride-along episodes. We recorded a bunch more, and we're getting our own internal process figured out for getting them recorded and out on time. So we're meeting with our team tomorrow to get a timeline and get our project manager working on board. So our goal is to have every other week a new real estate ride-along show published. So last week we walked what did we walk?
10 unit?
A 10 unit?
Yeah.
No, it was a 22 unit. There's a place in
this week that they're going to release.
No, on Wyandotte. That we walked your place last week, and we also walked a house in the ADU.
Okay.
So we walked a couple properties last week, and we'll keep walking, a lot of these small apartment buildings. So check out the show. Listen to the feedback. We did take the feedback from the past episodes. Hopefully it's going to be just better every time we do more rounds. So we appreciate you listening, and we look forward to a lot more of these.
That was great. Good work, Chris.
Thanks, everyone.